In this video, I'm going to walk through an explanation of the Markowitz portfolio optimization model, and then also work through an example of how to calculate the optimal weights of assets in a portfolio to give the best risk-return trade-off. To give you a little vocabulary on the Markowitz portfolio optimization model, we start with a minimum variance frontier, and that's the graph of the lowest possible variance that can be attained for any given level of expected return. The global minimum variance portfolio is the portfolio of risky assets that has the lowest variance of all risky asset portfolios. The efficient frontier is the range of all investments that are within the minimum variance minimum variance frontier and are above or have a higher return than the global minimum variance portfolio. So what we're looking for is the portfolio of risky assets that give us the best risk-return trade-off using the Sharpe ratio. So the expected return for a portfolio is calculated as the sum of the weights of each stock in the portfolio multiplied by their expected returns. The variance of a two-asset portfolio is calculated as, and for our assets we're going to use X and Y, so think of these as stocks, and the numbers we have here are the weights and the returns and the variances of those returns. So the variance of the portfolio returns is equal to the weight of each of the two assets in the portfolio squared multiplied by the variance of the returns of that asset plus the weight of the second asset squared multiplied by the variance of that asset plus 2 times the weight of the first asset X and the second asset Y multiplied by the covariance of their returns. If we generalize the equation to accommodate for more than two assets, we get the following equation that says that the variance of the portfolio is equal to the double summation of the weight of each asset I multiplied by each asset J multiplied by the covariance of their returns. We're going to operationalize this later on. So after we move past the two-asset portfolio, it's necessary to use matrix multiplication to determine the optimal asset weights in the portfolio. The expected return for the portfolio is calculated as, so this is E and in parentheses RP for the expected return for the portfolio, is equal to the weights transposed multiplied by the returns for each of the assets in the portfolio. So down here I have the capital W is the vector of weights of the individual assets in the portfolio, and R is the vector of expected returns in the individual assets in the portfolio. The formula in Excel, so the way you type this in, you type in equals mmult, and that stands for matrix multiplication, parentheses, transpose, open parentheses W, close parentheses, comma, and then the array of returns. So W is the array of weights, R is the array of returns, and then we close that out with another parentheses. And then to get the curly braces, you're going to hold down Control Shift and then press Enter. And I'll demonstrate this in the video where I walk through calculating these returns. When making calculations with arrays in Excel, type in the formula but don't press Enter. Instead, hold down Control Shift and then press Enter. This tells Excel that you're making a calculation with an array and puts the curly parentheses around the formula. The variance of the portfolio is calculated as the array of weights transposed multiplied by S, and S is the Variance-Covariance Matrix. And then we multiply that again by the array of weights in the portfolio. And then the standard deviation of the portfolio is just taking the variance of the portfolio and finding its square root. And as I mentioned above, S is the Variance-Covariance Matrix. The covariance of an asset's returns with returns for the same asset, such as the first item in the upper left here, or sigma 1, 1, is the variance of the asset's returns. So it's just the variance of the returns for an individual stock. The definition of W remains the same as above. It's the array of weights of each stock in the portfolio. The standard deviation of the returns in the portfolio are calculated in Excel as Again, we wouldn't put the curly brackets out there. We're going to just put an equal square root, open parentheses, mmult, open parentheses, mmult, transpose, then the array of weights, comma, the variance-covariance matrix, close parentheses, comma, and then the array of weights again, 2 more parentheses, and then we press down Control and Shift and press Enter. The optimal weights for each asset in a portfolio are the ones that maximize the value of the Sharpe ratio for the portfolio. And that's calculated as the expected return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. The next topic is capital allocation and the separation property. So in this first part, what we're going to do is we're going to take 4 different stocks to form a portfolio, and then we're going to find the right weights of those stocks to give us the highest Sharpe ratio. And then we're going to look at an individual investor who has their own level of risk aversion. We're going to determine what proportion of this investor's wealth we should put in that risky portfolio that we've created and how much should be allocated to a risk-free asset. So the optimal mix of weights for the assets in the risky portfolio is the mix that creates a portfolio along the efficient frontier that is tangent with the capital allocation line. This results in the CAL with the largest slope, the Sharpe ratio, and is therefore the optimal risky portfolio. The separation property says that there are 2 independent tasks involved with the portfolio choice property. The first is determining the optimal risky portfolio, and that's what we're going to do first. And then the second is the capital allocation between the risky portfolio and the risk-free asset. And we're going to calculate that based on the following equation that says the optimal weight in the risky portfolio, that's Y star, is equal to the expected return on the portfolio minus the risk-free rate divided by a person's level of risk aversion, which we use a number to signify that, multiplied by the variance of the portfolio. All right, so let's move over to the spreadsheet, and it should look like this. What I have for you here, I've downloaded the prices for the last 5 years, monthly prices for the last 5 years for 4 different stocks. Molson Coors, they make beer. Apple Computer, which makes cell phones and computers and other technological devices. Westar Energy, which is an energy company in Kansas. And then Union Pacific, which is a railroad. What we're going to do is we're going to calculate the returns for each of these for each month. And then we're going to start by calculating the average annual return and the annual variance for each one. So let's start here with Molson Coors. I want to point out that I've used the dividend adjusted prices. These are available on Yahoo Finance. They're also available through S&P Capital IQ. What these prices do is they incorporate the payment of dividends. So whenever you calculate the returns using these prices, it also calculates the returns from the dividends. So the prices are adjusted to reflect the returns from dividends. The way we're going to calculate the returns is that we're going to put in equals ln, which stands for natural log, and we're going to put in the numerator the most recent price. So here we're going to put in the price as of January 1st, 2018, divided by the price for the previous month, and this gives us a continuously compounded return for the stock over that time period. So we press enter. And I already have this formatted to give us a percent to make it look nice. I'm going to pull this over, and it's going to calculate that for the first month. And then I'm just going to pull it all the way down, except for the last row, because that would give me an error message. I'll just show you what it looks like. We don't want that. So now we have 4 columns of returns for Molson Coors, Apple, Westar Energy, and Union Pacific. So to calculate the average monthly return, I'm just going to put in equals average, open parentheses, and now I'm holding down the shift key and pressing the up arrow to highlight each one of these returns for each month. So for Molson Coors, I get an average monthly return of 1.2%. I get a monthly variance, and here I'm going to put equals var.s, and that gives us a variance using a sample. Again, I'm going to highlight the returns for Molson Coors. The average annual return, because I'm using continuously compounding returns, I'm going to use a compounded annual return. So I'm going to put an equals 1 plus the average monthly return, and then close the parentheses. Because that's a monthly return, I'm going to raise this, use the press shift and 6 to get the up caret to the 12th power, and then I'm going to subtract 1 out of that. And this tells me that the average annual return over this 5-year period for Molson Coors was 15.35%. And then to calculate the annual variance, I'm just going to take the monthly variance and multiply it by 12 to get 3.78%. So once I have those, I can just pull my cursor over all of them, grab the box here in the lower right hand corner. When you do that, you're going to see a plus sign, and then press down on your left mouse button and pull it over, and it's going to calculate everything for each of the individual assets that we have in our portfolio. So what we see here is that the average annual return for Molson Coors over the time period was 15.35%. For Apple, it was 23.11%, so they had a pretty good run there. For Westar Energy, it was 14.87%, and then for Union Pacific, it was 18.07%. And then down below, we have their variances. Apple, with the highest return, also has the highest variance. Westar Energy has the lowest variance at 3%. So going up to row 3, column O, we want to put the returns in that we calculated below. And all I'm going to do here is press equal and select the annual average return for Molson Coors, and do the same thing for Apple. I'm going to do the same thing for Westar Energy, and finally the same thing for Union Pacific. All right. So we have our returns, and now we want to calculate the variance-covariance matrix. To make this a little bit easier, I'm going to name each one of these arrays that has the monthly returns in it. So for Molson Coors, I'm going to put my cursor on F3, hold down Shift and Control, and then press the down arrow, and that highlights all the returns for Molson Coors for that time period. Then I'm going to go up into this area here where it says F3, and I'm going to name this, and Molson Coors' ticker symbol is TAP, so I'm going to name this TAP, RET for TAP return, or the returns for Molson Coors. I'm going to do the same thing here for Apple. I've got my cursor here at G3. I'm going to hold down Control and Shift and the down arrow, and I'm going to put in their ticker symbol AAPL and then return. For Westar Energy, I'm going to do the same thing. Their ticker is WR, so WR return for Westar Energy return. And then finally for Union Pacific, I'm going to do the same thing, hold Control and Shift, press the down arrow, and Union Pacific's ticker is UNP, and so I'll put UNP return. So now that I've named each one of these columns, calculating this variance-covariance matrix is a lot easier. We're going to use the sample variance and the sample covariance in this matrix. So I'm going to start off here. We have Molson Coors and Molson Coors, so we want to calculate the variance of Molson Coors returns. And I'm going to multiply each of these by 12 to give the annual variance. So I have equals var.s for sample variance, open parentheses, and my name for those returns, that array of returns, was TAP return. So you can see that here, it pulls it up. Close parentheses, and then I'm going to multiply that by 12. And I get 0.0378277768. Then I'm going to calculate the covariance of Molson Coors and Apple. So here I put equals covariance dot s. The first array will be the tap return, comma. The second array is the apple return, close parentheses. And again, I'm going to multiply that by 12 to get the annual amount. And I get 0.015736. Then I'm going to do the same thing here for Westar Energy. Westar's array was named WR return, and then I'm going to multiply that by 12. Then finally, I'm going to find the covariance of Molson Coors and Union Pacific. And I get 0.0027873. Now, the variance-covariance matrix is symmetrical, so the covariances of Apple and Molson Coors will be the same on both the column and the row. So here I can just press equals and pull up the covariances that I've already calculated. So now I need to find the variance of Apple. I'm going to put in equals var dot s. And now I'll calculate each of the covariances for all of the assets with Apple. Again, this is symmetrical, so I don't have to put in the formula for each one. So now I'm going to calculate the variance for Westar. So I'll put var s. The covariance of Westar and Union Pacific. And then finally, the variance of Union Pacific. So after I fill in a table like that, I want to make sure I put in everything right. So I go to Formulas, and then Show Formulas. I want to double check to make sure that I multiplied each of the covariances and variances by 12. And so you can see I did that. And then when I want to get out of the Show Formulas, I just press Show Formulas again. And so now what I've got the variance-covariance matrix, I've got the returns, so I can calculate the expected return, the standard deviation, and the Sharpe ratio. First, what I'm going to do is calculate it for an equally weighted portfolio. So because we have 4 different assets, the weights of each asset in the portfolio is going to be 25%. And down here I want to put an equals sum to sum all the weights, and those weights have to be equal to 1. So going back to our document, we need to calculate the expected return of the portfolio. We're going to use the following formula, where we put in equals mmult transpose, then the the weights of each asset in the portfolio multiplied by the expected return of that asset. So I'm going to put in here for expected return equals mmult for matrix multiplication, transpose. We're going to transpose the weights, close parentheses, comma, the returns up here, then close parentheses again. Now I'm going to hold down the Control and Shift buttons and then press Enter, and I get an expected return for this equally weighted portfolio of 17.85%. The standard deviation of the portfolio, if you go back to the document, it looks like this. On the second page, I've got the Excel formula. It says equals square root, mmult transpose, the weights, the variance-covariance matrix, and then the weights again. Make sure to get the right number of parentheses in or you'll just get an error message. So I'm going to put in equals square root, mmult transpose. I'm going to transpose my weights, close parentheses, comma, the variance-covariance matrix, so just highlight the numbers here, close parentheses, comma, the weights again, close parentheses again, and then I'm going to press Control Shift and then Enter, and I get 11.98%. The Sharpe ratio is calculated as the expected return on the portfolio. So I've got my numerator here. I'm going to put in open parentheses, expected return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. And so we have a Sharpe ratio here of 1.073146. So now what we're going to do is we're going to find the optimal weights for this portfolio. I'm going to start out like I did for the equally weighted portfolio, and I'm going to just put in 25% for each weight. The key here is to make sure you put in that the sum is equal to the sum of the weights. Don't just put a 1 in there because it won't work. We have to make sure that the sum is the sum of the weights, and that sum has to equal 1. So now I'm going to calculate the expected return on the standard deviation just like I did above. I put in equals mmult transpose. Now I want to use the weights down here, so I'm going to transpose those weights, close parentheses, comma, put in the returns above, close parentheses, and then press Control Shift and Enter to get the expected return. And then the standard deviation, just like we did above, is equal to the square root mmult transpose, and we're going to transpose these same weights down here, close parentheses, comma, highlight the variance-covariance matrix, close parentheses, comma, and then the weights once more, close parentheses, and then do it one more time to get all of that in the square root. Then press Control Shift and then Enter. And I do it this way, I do it twice just to double check my work. So I want to, because I'm using the same weights, I want to see the same expected return in the same standard deviation. Now I'm going to once again calculate the Sharpe ratio, the expected return minus the risk-free rate divided by the standard deviation. So to find the optimal weights for our portfolio, my goal is to maximize the Sharpe ratio. I'm going to use this. I'm going to do this in Excel using Solver. So you can go to Data, and you might see up here Solver, but if you don't, here's how to get it. If Solver isn't up here in the upper right hand corner, go to File and then down to Options, and you want to go to Add-ins on the left hand side here. And then down at the bottom it should say Excel Add-ins, and press Go. And if Solver is unchecked, you need to check that. Press OK then once you do that, and then Solver should appear up here. So once you get Solver up here, we want to open that. I've got stuff in here. I don't want any of this because I want to show you how to get everything in here. So I'm going to clear it, reset it all. So my objective is to maximize the Sharpe ratio. So objective, make sure your cursor's up here, put in the cell for the Sharpe ratio, set the objective to maximize that ratio. And we want to maximize the Sharpe ratio by changing the weights of the assets in the portfolio. So I put my cursor here by changing variable cells, and I highlight just the weights. Don't include the sum there, just the weights. And now we need to add a constraint. So our weights have to sum to 1. We need to add an additional constraint, and that's this one down here, make unconstrained variables non-negative. So what can happen, and make sure to check this checkbox, because if you don't, then you might have a situation where Excel says, hey, you need to short sell one of these stocks because it's just bad. And so you don't want that. We don't want short sales. The minimum, if you check this box, that means the minimum weight that you're going to have in any asset is 0. So once you've got your solver parameters looking like this, you can just press solve. And then it says solver found a solution. All constraints and optimality conditions are satisfied. We want to keep the solver solution. We're going to press OK. And that in our solver solution says that we need to have only 3%, approximately 3% of our portfolio in Molson Coors, 32.6% in Apple, 26.14% in Westar, and 38.1% in Union Pacific. Those weights sum to 1. That gives us an expected return of 18.79%, which is higher than the expected return of the equally weighted portfolio. It gives us a standard deviation of 11.97%, which is barely smaller than the standard deviation of the equally weighted portfolio, but it improves our Sharpe ratio from 1.07 to 1.15. So now the last step is to say how much does our investor, what proportion of their wealth should they put in this new optimal risky portfolio, and how much should they put in the risk-free asset, or like a U.S. Treasury bill. So we're assuming that our investor has a risk aversion level of 10, so A is equal to 10, and the risk-free rate is 5%. So I'm going to go over here, I'm going to pull back up the document we were looking at to get the equation. So the equation we want to use is this: the optimal weight, or the optimal proportion that we have invested in the risky portfolio, is equal to the expected return on the portfolio minus the risk-free rate, and that divided by our level of risk aversion multiplied by the variance of the portfolio. So down here I'm going to put in equals, and I'm going to put in open parentheses the expected return for our portfolio minus our risk-free rate, close parentheses, divided by open parentheses A, multiplied by the variance of the portfolio. So to get the variance, we're going to take the standard deviation, we're going to square it, then I'm going to close those parentheses. It's going to give me an answer of 0.96. So what this says is that we should have 96% of our investors' wealth put into this risky portfolio, and only 4% in the risk-free portfolio. Now, how does that change with different values for the risk-free rate? So the higher the risk-free rate, the more attractive that asset is. So if I put in 7% for the risk-free rate, we're going to put 18% of the person's wealth, our investor's wealth, in the risk-free asset, and 82% in the risky portfolio. If I decrease it, let's say to 3%, they don't want anything in the risk-free asset, and they're going to, the proportion they want in the risky portfolio is 110%. Not really doable unless we borrow money, and then it's going to change that outcome. So I'm going to stick to this here at 5% again. And then what happens if risk aversion goes down? So let's say the risk aversion level is 5. Again, the proportion they want in the risky portfolio goes up dramatically. And what if it goes up to 15? Then the proportion that we have in the risky portfolio goes down. So that concludes this lesson on the Markowitz portfolio optimization model. Please let me know if you have any questions.